In this video, I'll explain how the Australian tax system works and the types of taxes Australians have to pay in an easy to understand format, all in under 5 minutes. Let's get straight into it. Let's begin with income tax, which is the main form of tax for individuals in Australia. This is the tax you pay to the Australian government each year, which includes salary and wages, business income, investment income, and capital gains. The amount of tax you owe depends on your taxable income, which is your assessable income minus deductions. Assessable income is the income on which you must pay tax if it exceeds the tax-free threshold of $18,200. This income includes salaries, wages, business income, and investment income. Deductions are job or business-related expenses that you've paid for and can provide a receipt or invoice as proof. You can find a list of claimable deductions on the ATO website, which you can review yourself to see if any apply to you. I'll leave a link down in the description. Australia operates under a progressive tax system, which means the more you earn, the more tax you'll pay. Here are the current tax rates based on income. You're not taxed on the first $18,200 that you earn. However, any income beyond this is subject to a progressive tax scale, with the percentage increasing as your income rises. The tax rate starts at 19% and can go up to 45% if you earn over $180,000. Most Australians fall into the middle bracket, taxed at 32.5%. Please note these rates could change every year, so it's important to check the current rates if you're watching this video in the future. In Australia, nearly everyone is charged a Medicare levy. This is an additional tax used to fund some of the costs of Australia's public healthcare system, known as Medicare. Since medical care is largely free in Australia, everyone is expected to contribute a portion of their income to help fund it. The Medicare levy is 2% of your taxable income. Medicare levy surcharge. Individuals who earn above a certain threshold and do not have private hospital cover may have to pay an additional Medicare levy surcharge. Depending on how much you exceed the income threshold by, you may have to pay an extra 1% or more. Here is the current threshold and rates. To avoid paying this surcharge completely, you can take out an appropriate level of private hospital cover from an eligible health insurance provider. Usually, it makes more financial sense to buy private hospital cover since the cost will be less than the tax you would have to pay. Capital gains tax. You'll need to pay capital gains tax if you profit from selling something that has increased in value, such as shares or an investment property. For example, if you purchase shares worth $3,000 and sell them when their value rises to $5,000, the capital gain or profit is $2,000. This amount will be added to your assessable income. If you have shares that paid, let's say, $1,000 in dividends for the year, this is also taxable and will be added to your assessable income even if you have chosen to automatically reinvest it. Though it's not considered a capital gain but rather investment income, I thought I would mention it here since we're talking about shares. Please note your family home, also known as your principal place of residence, is typically exempt from capital gains tax. This is because you don't earn income from living in your own house. I'll now use an example to illustrate how to calculate income tax payable. Our friend Tom here wants to calculate how much tax he has to pay for the year. He has a $70,000 salary, gained $2,000 from selling shares, and received $1,000 in dividends from his shares portfolio. He also has $5,000 in tax deductions. To calculate his taxable income, we add his salary, capital gains, and dividends, which equals $73,000. After subtracting his $5,000 deductions, we get $68,000. Let's use this special tax calculator to find out his income tax payable. So let's enter $68,000. And according to the calculator, his income tax payable is $12,567. And the breakdown is as follows. No tax for income up to $18,200, 19% tax for this portion of his income, 32.5% tax for this portion of his income, which gives us the initial total. In addition to this, a 2% Medicare levy on his total taxable income of $68,000 amounts to $1,360. Adding the income tax payable and Medicare levy gives us the total tax Tom owes for the financial year. Once this is subtracted from his taxable income, we get Tom's income after tax and the Medicare levy. And this is how much income Tom has remaining after taxes. See, it's not that hard, right? I'll include a link to the tax calculator in the description below for your convenience. Goods and Services Tax, GST. Australians also have to pay Goods and Services Tax, or GST for short. While not an income tax, the GST is a value-added tax of 10% on most goods and services in Australia. It's collected by businesses, but ultimately it's paid by us consumers. The Aussie government uses this money to pay for things like schools, roads, and hospitals. So whenever you buy something, just know a little bit of that money goes towards helping the country. Superannuation. Australians have compulsory superannuation contributions, where a portion of your income is paid into a retirement savings account known as a superannuation account. Usually, this will be automatically taken from your salary and wages at work. These super funds invest your money for you for your future retirement. Please note these contributions are taxed at a concessional rate which is lower than the regular tax rates. Therefore, some people take advantage of this by contributing more than the minimum requirement, which is known as salary sacrificing. If you want to learn more about salary sacrifice, I'll leave a link down below. There are other taxes and levies in Australia that you may encounter, such as property taxes, stamp duty, and various excise duties on certain goods like tobacco and alcohol. The role of the ATO. The Australian Tax Office, or ATO, is responsible for ensuring individuals and businesses declare all their taxes every year by lodging what's known as a tax return. The Australian financial year starts on the 1st of July and ends on the 30th of June the following year. Usually, you'll need to lodge your tax return by the 31st of October, and if you use a tax agent, you can usually delay it until 15th of May the following year. A tax return can be lodged for the financial year by yourself online or through a registered tax agent. If you have a business, it's recommended that you go through a tax agent to ensure you have declared all your income correctly and you have included all your eligible deductions. By the way, if you're enjoying this video or found it useful, comment the word kangaroo down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit that subscribe button and join this wonderful community. Also, please consider signing up to my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, or any cool life updates from me. And if you're interested to learn how to maximize your Australian tax return this year, check out this video on screen. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.